has pretty much increased since 2023 from consensus estimate target prices on the stock from $3.10 up to close to $4.30 at the moment. So on its plan, I mean, this is, I really love to bring this stock to the forefront because obviously it's a heavyweight, one of 4 heavyweights in the STI. It's one of our 4, maybe 3 most traded stocks on a day-to-day basis. And it's also taken the challenges of COVID to look within and find ways to provide shareholder value from its existing assets. Basically finding a way to obviously find cost savings, find optimal solutions for its existing associated companies. It's sharpened its focus, obviously, on its business as well in connectivity, in digital infrastructure, as well as digital services. And by going in and looking at its balance sheet, it's been able to monetize $8 billion already, and has a target to further monetize around $9 billion, $9 billion thereabouts. So this strategic reset or value unlocking, I think, is a theme that you can run through many stocks that are really priding themselves on productivity, finding ways within to increase shareholder value. A number of companies, they obviously can look at buybacks, increase payout ratios, but it's when they're actually looking at monetizing asset and recycling the money into new ventures, pivoting into new industries, that I think is getting a lot more of the attention of the investors. And the good news is we've got a lot going on in this space at the moment. And this one sector as well, in terms of net institutional inflows, has been pulling in more and more. In fact, this year we've also seen the combined trading turnover increase significantly from around 235 million last year to around 280 million this year. And what I think is interesting is, okay, this one stock, ST Engineering, has led the STI so far this year. In many ways, what the stock has been doing over the last 5-6 years is very globally politically correct, if that makes sense. The stock have made a very big investment in the US into Middle River Aerostructure Systems, which is a very big fabrication manufacturing plant just outside of Baltimore in Washington, and has also basically ridden this productivity drive, obviously increasing revenue, but increasing its net profit by more than its revenue last year, has obviously been well received by the market. And the stock has also seen a significant increase in its turnover and has seen the 3rd most net institutional inflow in the stock market this year, after Singtel taking the pole position, followed by Singapore Airlines and then ST Engineering. And it's also part of this sector that I think has been pretty quiet for a long time overall. And global forces now are putting this really into the spotlight, because you've obviously got a massive realignment of supply chains and trade flows. The companies, we were hoping this year in the financial reports and statements that companies would be revealing just how much AI was helping their productivity. But instead, a lot of the narratives are more on exactly how much trade and revenue exposure we have to the United States and China and so forth. So there's obviously a lot more realignment and focus now on diversifying and fortifying supply chains. And this really matters for Singapore, which has a big presence in the region in services within the industrial sector. We also have a very strong economy on a comparative basis. We have a very strong pipeline of public and private construction projects in the next few years. We have incredible fiscal buffers when you're looking comparatively, and very strong infrastructure. So the construction pipeline here is super strong. And you've also got the big disruptor of AI. And I'm talking about AI robotics, which is a big plus for increasing productivity and value in this sector. That photo in the bottom right, in the bottom left, that photo is the foundations for what's going to be Singapore's tallest building in a few years. This is 8 Shenton Way. And you can see the concrete fill there. And thank you, Chalpaya. I took this from your Edge magazine, this photo. Thanks. This photo is actually showing their concrete pour, which was 10,000 cubic meters, achieved in 35 hours, using AI to make sure every nook and cranny was filled in the most productive way possible. So we're seeing a lot of ISO team, you've got ISDN, you've got a number of companies here that are being able to use the AI robotics to reduce their costs, increase their productivity. So that's the third of three very strong catalysts for this sector at the moment. The strong construction pipeline at home, the realignment of trade, and the massive role that industrial services has in regional supply chains, as well as the advent of AI. The SDI banks are also looking at productivity in terms of valuing up, and DBS is leading the charge in terms of the buyback mandates, while UOB in the meantime is actually leading the charge in terms of the execution of the buybacks so far this year. I think this is interesting too, because banks and Singtel, we're not really dwelling much into mid-cap, small-cap territory here, but the DBS is our most traded stock. Obviously, it's our largest stock. And I think what was really interesting was that the retail market, just in those 2 weeks alone, in the first 2 weeks of April, retail investors collectively net bought, so by net of selling, 800 million in DBS shares just in the space of 2 weeks, when it had that big drop based on the 2 weeks that followed Liberation Day. So the stock, they've been performing pretty strong. We've had 10 consecutive quarters of combined net interest income of more than 8 billion Sing dollars. Now, the net interest income makes up 2/3 of their total income. The other third is non-interest income. That's also been reaching highs and illustrated in this bottom chart. Had its second highest quarter last quarter. And this is one we're watching for this upturn in terms of particularly wealth management services, treasury trading, and so forth as a key driver. But at the same time, you've got a lot of, buying in the banks. It wasn't just DBS. In fact, when the banks did take that 14% plunge in the first 2 weeks of April, overall retail net bought about 1.5 billion in the three banks alone. So this is one that I would encourage you to scrutinize a little bit more with the data and the information that you're given by the brokers. When you look at the retail flows, have a look at it, compare it to the size of the stock, and compare it to the prices. Obviously, it's always backward looking, but you will see that generally Singapore retailers do, over the last 5 years, have a history of buying stocks when they are sold off significantly and selling off when they're performing well. Now, in April, remember, the big defensive play was Singtel. That actually was in the green versus the rest of the market being in the red. So guess what? Retail investors were selling to pay for the bank transactions. They were actually selling Singtel. So this rotation is I think, a really critical part to our market because it covers so many different bases. And I think that's going to be really important for our REIT sector at the moment. Now, I've got the price of our iEdge S-REIT index in the dark blue line. I've got consensus estimate target price from Bloomberg in the light blue, and then in the aqua in the middle is the Fed fund rate futures for the US, where the Fed fund rate will be in December. So I think this should be my last. Yeah, this will be. I'll make this the last slide to have the lead in to the REIT presentation. There's a few things about this chart that I wanted to share. The first is that dark blue line. You can see it's there at 997. I think I put this chart together on Tuesday. Now that blue line's at 1020, which means it's 10 points off from 1030, which has acted as a threshold somewhat since December of last year. So you've got 7 months of this horizontal type of resistance at 1030 containing the index. If you also look at the the light blue line right at the top where it says 1147. That's the consensus estimate target price for where it should be in 12 months. Now, they're always usually above where the index is. That there's nothing untoward or different about that. But it's around 15% higher than the index level. And this consensus estimate target price is really low. It hasn't been this low since 2016. And it's been revised downwards from 1550 in January 2022. It's come down very low indeed. Now, the other thing that I wanted to draw your attention to is the blue line in the middle will be higher now because this week you've had expectations for the Fed funds rate over the next 4 FOMCs before 2026. Majority expectations are now 75 bits of cuts versus 50 bits of cuts. Reason being is there's a little bit of argy-bargy now at the Fed Reserve. Now, this has been brewing, I think, since March. So so go back to 2020 when Donald Trump was in his first administration. He appointed Federal Governor Christopher Waller. And it was in March that the Governor Waller said that she was the sole dissenter to a decision to keep decelerating quantitative tightening. Then in April, he was actually pretty supportive of the tariff measures and came out with a great speech, A Tale of Two Scenarios. That link, you can just go and Google Chris Waller speeches and you'll find it in mid-April. He was basically giving the market scenario one. It kind of works out well. And at the moment, markets are expecting it to work out well. Markets are expecting a generally 15% tariff rate to be sustained by the US across the board, which will bring in close to $500 billion US of revenue versus the old regime, which was only around $80 billion of revenue. But it will also impact inflation from 1 to 2% in the US. So towards the end of the year, you're going to have a lot of focus on the PCE core deflator, which could be up towards 4%. The good news is it's expected to be just a one-off. So this is a real transitionary inflation. This is just like GST was in Singapore. You had 1% at the beginning of the year before and 1% last year, and that had this one-off impact. So that is what the consensus is in Wall Street now in terms of expectations. Now, Christopher Waller, back in April, gave those generally two scenarios. And then this week, he, on I think it was Bloomberg, has gone out and said, we should start cutting as soon as July. And for that reason, the thing has changed. He's become the obvious heir apparent. Now, what does that mean? If you've got an heir apparent to the Fed Reserve that his economic philosophy is very, very much aligned with the White House, then what has Donald Trump been calling for Jerome Powell to do more of? Cut. So this is another thing relevant to the outlook for global interest rates. Remember, we were talking about that, the 2010s and 2020s. You'll never see it again, but you don't know. You can't discount it now. It is a risk. You might have ultra low interest rates again. But you might have also noticed in Singapore, we're also in a little bit of a new territory. We've got a really strong Sing dollar, but what we don't have is really strong high interest rates. So your SORA has been coming down. Your 10-year yields have been coming down. Meanwhile, you can see the yields have been maintained on the REITs. The REIT managers have been working really hard to get positive rental reversions, keep their occupancy rates up, really work on delivering income as well as high DPUs. And by churning away and doing that work, you've got a number of REITs that are maintaining pretty high yields in what's pretty much at the moment one of the world's strongest currencies. So what we're seeing is you can see this, the blue line here, the blue histogram here, you can see over the last year, it's mostly net institutional outflow, right? The blue line versus the retail, which have been consistently buying in tranche. But what's happened is we're starting to see this turn a lot. So at that time, So this was the week before last. You had $78 million of net institutional inflow, which is the strongest we'd seen on a week since September of 2024. And then when I looked to update it yesterday morning, that it was actually 100 million of net institutional inflow over the preceding 5 sessions. So this is one thing to really watch closely. Do the institutions return to the sector? Are they getting less selective? Because when you look at the selectivity this year, the REITs have been performing really well for the investors who take that selectivity to 3 levels, i.e., where in the world are the REITs investing? What are the types of properties they're investing, and what are their metrics and gearing ratio like? And that's why this year, so far in our REIT market, for the first 6 months or so, the real theme was the Singapore assets, particularly in some of the retail, the health, the hospitality, some of the more defensive sectors, albeit with less, the growth indicators, the economic reports weren't as strong as we had thought, but nonetheless, they were 2 key criteria, along with the lower gearing ratios, and that's why CICT, Fraser Centrepoint Trust have really led so far this year, particularly in net institutional inflows as well. So the good news is we're seeing a lot. Sorry, I've been more than 15 minutes. So the good news is I think we're at the right time, the right place, and I should have put more time into REITs, but nonetheless, you're going to get a lot of great insights into REITs right now. If you don't want to go all lump sum, do consider dollar cost averaging. Remember I said the STI return since the end of 2019 to yesterday was 8.6% every year, compound annual growth rate. If you didn't go lump sum and you did an equal amount of money at the end of every single month, you would have still been able to capture the lion's share of those returns. It's actually 6.3% is your compound annual growth rate by putting an equal amount of dollars into the STI at the end of every single month since the end of 2019. Now, this is really important because this is a theme in Singapore, this cautious, optimistic outlook by basically trying to mitigate your timing risk of buying at the high and then market going down all the way while you're still holding on to that lump sum investment, trying to capture the volatility, make it work for you. So you end up buying, if you're putting an equal amount of money into work, you end up buying less at the highs and you end up buying more at the lows because your unit prices decreased a lot. And that's how this would have worked in the STI. In the meantime, I'll also say retail investors, as I said before, like to be buying low, like to be selling high. You can see that when you look at the $16 billion of money that retail investors have net put or net bought into our market since the end of 2019. And many of these ETFs or dollar cost averaging plans, which we estimate have 100,000 retail investors in Singapore using, are available on your real estate investment trusts as well as your ETFs. All right, I'll leave it there. Thank you very much.
We do have Mr. Sim Kuan Chung, Managing Director from Shore Advisors, to share more. Right. Together to invite Mr. Sim.
Hi, good morning. Thank you very much, Jeff, for softening the ground because he covered a lot of the Fed as well as the S-REIT markets in terms of institutional flow. But hopefully, I will be able to add more insight into what he has said and build on that. Maybe I'll just jump around to a slide that builds on what he was saying. This is the current constituents of the IHS REIT Leaders Index. And on the top right-hand side shows you the total returns for the index. And you can see from the bottom right table, between 2011 to June 2025, it generates a return of 7%. So if you recall, this probably would be a high interest rate to a high interest rate return. So it gives you a 7% compounded return annually over the period if you just buy and hold. However, if different interest rate cycles, you might be getting a higher return. So the second line between 2011 to 2021, it actually gives you a total return compounded of 12% a year. So bear this in mind when I go through the S-REIT outlook for you. So my name is Casey. I'm from Shore Advisors. Shore Advisors is the financial advisors for the CSOB IHS REIT Leaders Index ETF. I've been doing fund management in the property space for the last 15 years, investing in Asia Pacific real estate equities. And today I want to share you the outlook. Shore Advisors is part of the PhillipCapital group, where we are a professional investment management firm that helps family offices, ultra high net worth individuals, as well as institutional investors manage their real estate, their wealth, as well as their investments across the public and private markets. Paris, the Middle East war, and the oil shock, all these headlines are probably what you have been hearing in the last couple of weeks, or even the last 6 months since Trump has come on board. But first, let's look at how the Singapore economy is coping. And then I will explain why S-REITs should outperform, as they are safe haven assets with very resilient cash flows. The rates are now turning lower, making them pretty attractive investment options. So if you compare with the fixed Ds, the treasury bills, the Singapore government savings bonds, roughly in the 2% or low 2%, as well as the fact that the banks are likely to do less well if the interest rates are going to turn lower, because the net interest margins are going to be pressured. So if you look at the top left-hand chart, the first quarter growth was actually pretty decent, but it is mainly propped up by a lot of front-loading of exports to the US. Everyone is fearing tariffs, and as a result, the US importers are importing in big bulk, building up the inventory before the tariffs hit them. So you are seeing that happening now, even for April and May. The last 2 months probably is receding a little bit. And because of the weakening expectations after Liberation Day, the reciprocal tariffs, the Ministry of Trade and Industry has actually narrowed the 2025 growth forecast to 0 to 2% versus the earlier 1 to 3% early part of this year. As a result, I think, understandably, the business sentiments are weakening. But fortunately, I think Singapore has one of the lowest tariff rate imposed on them at 10%. And there might be likely to be preferential or zero rates for the pharmaceutical as well as the semiconductor, as the US wants to secure their supply. So we are actually not so bad versus the rest of our neighbors in the ASEAN region. But as an open economy, we are very much impacted by a slowdown in lower business that our neighbors are going to do if the tariffs actually persist at these high levels. But actually, if you ask yourself this question, would the high tariffs persist eventually? It seems like not, because there has been a lot of tacos that's gone on around. No deal is actually seen as a good deal by the US currently. So we are likely to see lower tariffs than what we are being told about. But however, I mean, the uncertainty is actually quite not very good for confidence in terms of business as well as investments. So why would S-REITs outperform in this environment? I always refer to this chart and this framework to analyze the S-REITs, because by nature I'm a fund manager, so I look at all different factors and see which one is turning and which one is not turning. So if you look at this chart, I mean, simply the airplane with the red arrows are headwinds, and the airplanes with the green arrows are tailwinds. Since 2022, inflation and rising interest rates have impacted the REITs. The growth has been curtailed and the distribution has been slashed. What are the factors that have been affecting them over the last 2 years? Strong Sing dollar, diluting the overseas income, as well as the asset value. The utilities and operating costs were very high in the initial years. Everyone gets a pay rise to deal with the cost of living, so the operating cost has gone up. And borrowing costs rose to the highest in over 15 years. Unfortunately, I think we have seen the cost inflation pass us, and now the REITs are benefiting from rent inflation. So the landlords are actually getting their proportional share of the increase in the returns to compensate for the increase in the cost. So with REITs slowly turning around, REITs will likely to turn around as interest rates have now turned lower. So based on this framework, we always see which factors are turning and not turning, and then that will factor into the analyst and market expectation of positive reversions to the distributions for the forward period. And REITs usually pricing these fundamentals and macro changes 2 to 4 quarters ahead. What kicked the ball rolling was when the Fed started cutting rates last year. But that was disrupted because Trump came on board and implemented all the things that he has done so far. So as a result, Fed has been on hold for the last 2 quarters because the Fed thinks that given the tariff impact are unclear, they want to adopt a wait and see stance. But I think in this month's testimony, Powell actually says that the recent data actually suggests that without the tariffs impact, they would have cut the rates by another 5 cuts, 125 basis points to neutral from current levels. They do expect the tariff impact to come through, it's just that they do not know what kind of impact is it. And based on what the tariff negotiations are going, that tariff impact might not be as much as what people are thinking. So this chart I created about a week ago. I think they were still pricing in about 4 cuts by the end of 2026 or 2 cuts by the end of 2025. I think Jeff mentioned that this is now pricing 3 cuts to 75 basis points. And if Trump do nominate a new Fed chair way ahead of time, like 10 months before Powell is due to step down in the middle of next year, then the markets will start pricing in lower rates and faster. So I think Jeff briefly described why the Sing dollar, the Singapore interest rate and the Fed interest, US interest rate have diverged. Why? Because inflation is cooling with the core CPI now below 1%. In fact, I think it was 0.6% as of the most recent data. MAS therefore has revised its core inflation forecast to 0.5 to 1.5%. Why? Because with an eye on the weakening growth that we are seeing, with inflation lowering, the MAS has already made consecutive slope reduction in the net effective exchange rate. Recall that Singapore does not have an interest rate policy. We only have a currency policy where we manage the exchange rate to make influence on the exchange rate. So since the start of the year, that has gone down by 100 basis points. And correspondingly, Singapore interest rate in terms of SORA, Treasury bills, have all fell similarly year to date about 100 basis points. And with the weakening growth coming out, MAS is likely to further ease in the second half of this year. US and Singapore interest rate have diverged and the gap has actually widened. Why has that been the case? Because I think with all the disruptions that Trump has been putting on the market, most investors are actually quite bearish on the US dollar and US assets, and they have been hedging and repatriating their funds from the US into the Asian market, especially Singapore, which is known to be a safe haven. So with this unreliable and hostile US policy and fiscal deficit, they're also bearish on the long-term viability of the US dollar. Not helping that they're suggesting to have revenge taxes on the foreign residents. So Sing dollar as a safe haven, we have seen a flush of liquidity. So in the middle bottom chart, you can see where the flush of liquidity is shown, because currently the non-bank loan to deposit ratio is very low. So versus an amount of deposit in the system, the amount of loans they have made, there are a lot of money. In fact, I think 40% of these reserves are actually parked under the Singapore government securities currently, showing a lot of a wealth of liquidity in Singapore. So I think that diverging of the US and Singapore interest rate will continue. Jeff touched on this, on the exchange rate. Singapore dollar has appreciated a lot against the other major currencies since 2022. All right, 4 to 9% for the US dollar, euro, and pound, 11% against the Chinese renminbi, 18% against the Aussie dollar, and 30% against the yen. So everybody's very happy to go to Japan. That has impacted a lot of these S-REITs that has overseas properties. So currently, I think within the S-REIT index, if you look through to all the S-REITs overseas exposure, 66, I think roughly about 66% is in Singapore assets and about 30% is offshore. So these offshore earnings has been killing the S-REITs in terms of their earnings as well as the distribution. But fortunately, I think that has started to turn. So year to date, Sing dollar has started to depreciate against the pound, the euro, and the yen, but appreciated against Aussie, the US dollar, and renminbi. So it's balanced, but I think with the MAS on the card, that will actually turn around, and then there's less pressure on the overseas earnings. In fact, to be a tailwind going forward if the MAS eases further. This chart shows the S-REIT cost of debt and the correlation with the S-REIT's performance. So if you use a Sing dollar 3-year swap rate as an interest rate benchmark, you add another 100 basis points roughly about the margin of the cost of debt. That will give you their current cost of debt if they go out to the market. And the dark line shows the S-REIT average cost of debt. So if you look at the periods, the shaded periods where the S-REIT average cost of debt is above where they can borrow, the S-REITs actually outperform because they are paying a higher, for example, 4% cost of debt, but if the new debt is at 3%, they're going to make interest savings, and then as a result, distribution will go up. And that's the pretty much correlation. And currently, I think since the start of the year, we are entering into the territory where the new debt is going to be cheaper than what they have in their books currently. And that will be very positive for the S-REITs. There's been a lot of concern on the S-REIT gearing. So currently, I think the S-REIT average gearing is about 40%. But this is not concerning because over the last 2 years, MAS has already allowed a lift in the gearing limit to 50%, but on a lower 1.5 times ICR. So we are no longer going to see any of the S-REITs going to do very dilutive equity raising, just like what they did in the GFC period. It is unlikely that they will do large-scale equity raising, but more like the recent deals they have been doing is to buy accretively, then they will try to raise the money. And they are prioritizing divestment to pay back more of the expensive debt instead. So with the drop in interest rates, it's actually also positive because they get a positive carry spread on their investment. So if you can borrow at 3%, you buy at 5%, you actually make money. To yield 5% yield to pay back your 3% cost of debt. So that has been pretty negative for the last 2 years when interest rates are high, but now all these various sectors as well as the various regions are actually turning green. And that's actually very positive because as REITs will grow, the prices will go up because they can buy accretively to add on to the assets to get inorganic growth, which is one of the main engine of S-REITs over the last 20 years that we have seen. There are other fundamental reasons why I think S-REITs will outperform the STI and banks. This chart shows the rent reversions across the various sectors in the Singapore space. The retail REIT has been able to get about 10% on average rent reversions over the last 2 years. I've mentioned about rent inflation. That has come through slowly because typically rent retail leases or even office leases are 3 years. You renew it every 3 years. So while costs come up very quickly, the rent negotiation takes a while, and then you wait for the leases to expire before you renew. And that is actually coming true. And with retail supply not going to be very significant, I think that will persist for a while. Similarly, office REITs, maybe like slightly lower. I think they had their good times in the last few years, but that is tapering off a little bit. So average about maybe 5%, because they are benefiting a lot from the tenants coming in back into the city from the fringes as well as the business park. I mean, going on to that, the industrial REITs actually are still doing pretty okay, mainly I think driven by logistics. Business park is actually not doing well because the vacancy is actually quite high in most of the business park with the new supply that's coming up in the Punggol Digital District as well. The hospitality REITs for the first quarter wasn't doing well. Well, simple reason because last year they have a big concert that came out that attracted people, but so this year they don't have. But I think going forward, the outlook is still pretty positive because the Disney cruise is coming up at the end of this year. And going for a longer term, medium to longer term, we're going to have a T5. They are not going to build a white elephant to double the Apple capacity without knowing that more tourists will come to Singapore. So this is a chart that I think Jeff had one that shows the earnings revision as well. This shows the earnings revision that has happened to the specific REITs over the last 3 years since 2022. The jagged lines, the 3 jagged lines, different colors, shows the current year and the next 2 years earnings estimates by the market. And you can see very consistently, you can see is top left, bottom right. They have been cutting because of all the reasons that I was telling you about. But I think we do see some sense of stability as the interest rate cycle turn and as the earnings growth that is coming through the rent revisions are coming up. So expect them to slightly start positive rent reversion over the next 2 years as they enjoy these interest rate savings going forward. So ultimately, I think as an analyst, when you look at whether you want to buy S-REITs or not, you look at valuations and how it compares to historical price to book, which is price over the NAV of the REITs. As a index, currently it is 0.87 times. So the historical average is the red line, which is roughly about 1 times. And you can see that over the last couple of episodes since 2020, I think it touches maybe 5 times. The 0.8 to 0.85 times has been support levels, and we are not too far away from that. So you might ask, maybe I think the values are not of the properties are not what it is, and it is lower, so that's why it's trading at a discount. But if you look at the recent transactions like Fraser Hospitality Trust as well as the Paragon REIT that privatized or try to privatize the company at 7 to 11% above book, then I think those values are actually quite real. This chart shows 3 lines. The top line is the Singapore 10-year risk-free rate at 2.3%. The bottom line is where the S-REITs currently dividend yield is at 6.4. So if you minus off these 2 numbers, you get the yield spread of 4.1%. That is the premium you get from taking on the risk of investments. You can see, just to highlight, the 2 axes are reversed. Actually, the 0 is on top and the higher value is at the bottom. So this is to say that at the top is expensive, at the bottom is cheaper. So 4.1% yield spread is the highest since 2022. But this is a very 2-dimensional way of analyzing the S-REITs. Typically, we look at how the impact on where the risk-free rate goes versus the yield spread. What's the fair price of the yield spread? So all the gold dots you see are monthly pairs of, for January, the risk-free rate is 2.3%, then the yield spread is what? 4%. And then you just plot it over the last 6 years since 2018. And as a result, you can see that there's a relationship where if the risk-free rate is going lower, interest rates are going lower, you demand a higher yield spread. So the black line tells you where the fair value is. And currently, I think at 2.3%, the fair value is roughly about 3.75%, and we are trading at 4.1 currently, where the yield spread for the S-REITs are. So it means that we are on the cheaper side for the S-REITs currently. Another reason why I think the S-REITs will outperform, when you compare to the other REIT markets, Australia, Japan, UK, the US, as well as Hong Kong. Hong Kong is mainly linked REIT. So at 4.1%, it's the highest among all. I mean, Australia as well as the US are seeing negative spreads. I mean, the yield on the REITs are even less than the risk-free rate. Hong Kong, roughly currently at 3.5, Japan, maybe 3.75. So I think we are very attractive. We are getting a higher premium than what other regional REIT markets investors are getting. Similarly, Singapore REIT has underperformed all the other regional markets I was telling you, even though they have tighter yield spread or lower since September 2024. Means why I choose September 2024, because that's when the Fed actually started cutting rates in the third quarter of last year. So we are ranked behind, and we shouldn't be, because based on what all the fundamentals and macro data I'm telling you, it shouldn't be. This is where the performance compared between Singapore REITs as well as the STI and financials. Since 2021, when inflation came through and interest rates started rising, S-REITs had underperformed the STI by 50%. Against the bank, even was 66%. On an index basis, STI, I think, maybe not, I'm not sure, but the US S&P 500 is at the all-time high. So the STI is not anywhere less. So it's near an all-time high as well. But S-REITs are a 10-year low. So if you look at the previous episode when the interest rates start moving down, the S-REITs were at near 10-year high back then, but now we are at a 10-year low. So at a starting base, a lot of bad news has already priced into the market already. And I think given that where we are looking at the interest rate, I think that is the start of something of outperformance for the S-REITs. So I hope all of you have a better understanding of why S-REIT would be a good investment option. And with that, I pass on to Raphael from CSOP to speak about this, how you can monetize this outlook on the S-REIT to invest in the S-REIT ETF by CSOP. Thank you.
Thank you. Let's welcome Raphael also from CSOP to share more about the REIT. And also pay attention to his session, because there will be a Kahoot quiz right after him, where there will be prizes for the top 3 participants as well.
Right, so thanks Casey and Jeff for sharing on the REITs itself. So basically, CSOP, we are ETF issuer, a leading ETF issuer based out of Hong Kong, and also we have a Singapore office. So we have over 50 ETFs listed on both Hong Kong and Singapore Stock Exchange that's readily available on the Boyang's platform. So in today's event, like Wan Zhe mentioned earlier on, just want to take your attention to this particular slide, because later on, there will be quizzes and games that which will be able to earn certain prizes out of this. So for the IHS REIT Leaders Index ETF, we engage Shore Advisors as our investment advisor. Together with SGX, we customize this index to gain exposure to the leading S-REITs itself. While how we compare ourselves to the other REITs providers or ETFs out there, for the IHS REIT Leaders Index itself, we don't just focus on the market cap. Most indexes, they focus solely on market cap. For us, we focus on both market cap, and also we embedded a liquidity tracking feature in it. So what this actually means is that you can be sure that your portfolio will always be rebalanced based on the most liquid underlying asset classes in itself. As well, we assign weightage based on this liquidity tracking data points. So for this IHS REIT Leaders Index, it's listed on ETF is listed on SGX with 2 share classes. one in Sing dollar, which is SRT, and one in US dollar, which is in SRU. So the total fees involved in this ETF is currently at 0.5% per annum, and so the total TER is kept at 0.6%. And the distribution for this ETF itself for dividend payments is paid out in semi-annual basis. Generally, we aim to pay out these dividends in January and also in July. So if you want to find out more, possibly we have a booth outside. You can come and engage us later on. So pretty much, I think that's for my sharing, and also thanks KC for the in-depth analysis of all the S-REIT leaders components earlier on. Right, I'll pass the time back to Hansen. Thank you.
Thanks, Rafael, and thanks, Mr. Sin and Mr. Jeff Howie. So right now, we'll be moving to one of the first Kahoot for this event. But before I mention this